Hi, everyone. I'm Rick Bensignor. Today is Tuesday, May 12th, and this is the weekly In the No Trader show. Today, we're going to do our market overview, as we typically do. We'll take a look at a few different markets and kind of just give you the sense of what's going on out there. In this week's Trader Education piece, we're going to talk about how do you figure out which online trading course is right for you. And then we will take a look at the semiconductor space within technology. You've got some names here that are up rather well this year. And so these are some of the large cap and mid cap names in the semiconductor space that you probably have a better chance of potentially owning already or might want to own compared to the small cap space within semiconductors, where there's lots of names that are doing well too, but you might not have heard of them. So we'll just kind of take a look at some of the more popular names in the space. So let's start with what's going on. The S&P right now is up about 2 points at 2932. High today is 2946. Earlier this morning, and we've been on both sides of the positive and or the plus side and the minus side today multiple times. Overnight futures got as low as 28.94, so that's about 30 points lower than where they are now. So we definitely saw some weakness overnight, and they got as high as let's see, what do we have here, 29.39, so about 14 points higher than this. So we've been from let's just say in round numbers plus 15 to about minus 30 or so, and it's kind of that type day. 10 years treasuries are at 71 basis points. They closed at 72 and change yesterday, which was one of their better closes as of recent. And oil is up another $1 today in the June contract, which expires on May 19th. So in a week from now, the June goes off the board. This has had a phenomenal run off of the low a couple of weeks ago when May oil went negative. June oil got down to about $7, if I remember. So now it's at 25 and change. But I suspect that there'll still be a fair amount of shenanigans that takes place between now and 19th expiration, simply because there's still way too much oil at hand and no place to store it. There's also 2 Saudi oil tankers that are close to being, are in the Gulf, and there's just no place to put this oil. So I have a feeling oil's going to come off again. The problem for most people is that most of the brokerage firms now that let you trade futures have stopped you from being able to trade the front month future. So witness this right now. There's, well, as of yesterday, I think it was, there's about 190,000 open interest in the June contract, and the July oil futures have essentially doubled that. So of course we are getting closer to expiration, and you'd expect June to start having less, but this already happened probably close to a week ago or so. That open interest went way above on the July contract, well sooner than you would expect it to relative to expiration date. And what else we have going on? The gold market. Gold's up about $14, $15 today, and still kind of in its trading range. Let's take a look at, well, before we do, just a reminder about subscribing to the No Trader, and what you get in it is a weekly piece that comes out Wednesday evenings, recommends a new ETF each week, as well as goes over in depth some of these markets that we talked about this morning. So I'm typically looking at, let's say, oil, the dollar, US 10-year rates, plus a very in-depth look at the S&P market, the major US benchmark index for equities, and how to position yourself properly there as far as for what's coming next, and what's the best way to position your portfolio. To get in touch with me, it's Rick at inthenotrader.com, and thank you for all the great emails I get each week. Often get a couple dozen just from this podcast or a show alone, thanking me for the information that I give, and sometimes asking a few clarifying questions, which I will gladly answer as I can. Let's take a look at the S&P macro sectors last week and this week. So this is showing the relative change. They're not scaled at the same heights, so the zero line is in different places. It's just kind of how the cut and paste followed through. But what I found interesting, so the chart on the left was year-to-date performance through last Tuesday, and now it's updated through today. And usually I like to highlight sectors that have moved more than 1% relative to the S&P each week, with either a red dot, which means it's fallen more than 1% versus the broad market in relative terms, or a green dot if it's done better. And usually we get a couple of sectors that show up. This week, to kind of give you a sense of just how much has gone on in the last week, 9 of 11 sectors have moved more than 1% in relative value versus the S&P since last week. And notice which ones have the green dots. They're basically what have been the winners. There's only one outperformer there in purple, the staples, that fell by more than 1% over the past week relative to the S&P. So the winners continue winning and the losers basically continue losing. However, energy stayed pretty stagnant at about minus 26 percentage points beneath the S&P, but that's well better than it had been. In fact, if I remember correctly, the S&P energy sector was probably down about, I think, close to 40% or so underneath the S&P's performance earlier this year. I think it was 3 weeks ago, I told you that I upgraded the sector, and since then, through last Friday's close, I don't know what's done this week, but through last Friday's close, it had outperformed the S&P by 12.2% in just 3 weeks. So it had gotten back a fair amount of what it had underperformed. Obviously, it's still the worst performing group, but it's just not as bad. And financials continue to fall. They were only down 17% or so last week. As of last night's close, they're now trailing the S&P by over 19%. So we're still seeing, the bad stuff kind of stayed bad and the good stuff stayed good. And that's really the tale of like two tapes now. You have the technology and communication sectors, which continuously do well, along with healthcare, and then your laggards continue to be industrials, energy, and financials. People are constantly saying that you cannot have a bull market if financials don't partake. Meanwhile, the S&P is at least 35% off of its low that it made on March 23rd. So certainly you can have a bull market without financials partaking. So I think those who say that are not necessarily correct, but certainly in a good, healthy bull market, you'd want to see financials be partaking and not trailing the S&P like this. Generally, you'd want to see them outperforming, and they're not. And that doesn't mean that it makes this bull move that we currently have any more suspect because the financials are not partaking, but in a better, healthy market, generally you want to see the financials north of the zero line and outperforming the S&P. Let's take a look at a few charts. So here's the take on that. Of course, this is not a benchmark index for portfolio managers, but it is what most news stations and business television stations will lead off with each day as what the market did. So you can see here on the March 23rd low, the S&P made an aggressive sequential 13 count, suggesting downside exhaustion. That was one of the key reasons I was a buyer that day. You've seen the rally since, and if we zoom in a bit here, you can see this green dotted line is the 50% retracement of the way back up to the all-time high. So we have pushed through there. We've actually gone on either side now for almost a month. Next level up is the 62% retracement at 25,230, and up here at 26.4. is the 200-day moving average along with the TDST line up here at 26.1. So I'd say anything north, once you start climbing north of about 25.5 or so, you get into a zone that essentially becomes what I would determine to be important resistance, and perhaps all the ways up as high as 27.4. But I'm still not in the camp that we're going to make new highs this year, and that we have already seen the range for the year, meaning that the highs back in February, the all-time high here in February, and the March 23rd low will be the range for the balance of the year. And because I believe that, as we get towards this upper part, I would likely do some portfolio long reduction. And if we get down in, let's say, down terms to near 22,000 or so, and beneath, I'd be a buyer. And so I think this low holds. I think all-time highs hold, and that the rest of the year is kind of back and forth. So that's how I'm looking at things as far as the S&P. If we look at the 10-year, we're finally starting to get a little break from this trend line. You can see this triangular pattern. So here's the day they made the lowest low in the TNX, which was March 9th, and you can see it's showing a low of about 40 basis points. I think I've mentioned before that 10-year rates actually got down to about 31 basis points overnight, but the TNX does not get tracked except when the New York Stock Exchange is open. And as such, it didn't even show just how low rates had gone. However, since that day, all the lows have really been at about 56 basis points. So the day after the low was made, 56 basis points, and here a couple of days, you're right around there. Here you open beneath it, closed above. Here you're just above. So you've got kind of a flat line near 56. We are at least slightly breaking out here. I've told people I want to see a qualified and confirmed close above 78 basis points. I'm sorry, 76 basis points. And if you can do that, then I'd look for probably something first 92-ish and then 97 or so as far as resistance. But I am at least glad to see that we're breaking out above the triangle. We haven't taken out the high end of the range yet, which is still somewhere right around where I'm saying the mid to high 70 basis points area. We're going to get some cloud chart resistance too, potentially. But if we properly break above this level, then I think that would indicate a likely thrust to at least get into the cloud, if not test the top of the cloud at 1.03% sometime in the next few weeks. And then lastly, before we get into our trader education discussion, let's take a look at, actually here, let's look at gold stocks instead of gold itself. This broke out from a triple, if not quadruple high, just about near 32 in the GDX. GDX is the most common ETF used to get exposure to gold miners. And you can see this is now moving higher. Worst case scenario here, pullback kind of gets towards the 28 area. I wouldn't see it getting really any lower than that if it pulled back, but there's plenty of room here. Not only did I say that if we broke through 32, you probably get a quick 20% move up to the upper 30s where you have some of these propulsion targets from the past. But if we look at longer term history here in the GDX, well, that's more than we need here. Take a look where all-time highs are. This was back in 2011, north of 65. So there's certainly plenty of room for this to go on the upside. And if you think about how many years this bottom was, right? Well, let's say 1 year, 2, 3, 4, 5, 6.5 years. It's very similar to gold having broken out last summer above 1375. And if that's the case, and this has any similar type pattern, and obviously gold stocks should have a fair correlation to how gold trades, but not exactly, then this really has room to go. And you'll want to be buying pullbacks. So it does look like it's time for gold stocks to be part of your portfolio if they haven't been, and or adding to anything you've bought, let's say, over the last few years. So that's my take on that. Let's now think about the, I want to go back to our PowerPoint and go back a couple of slides and just bring us to here. So let's talk about this, because each week now I try to bring in a little sense of trader education, teach you something that you might not know, clarify a technical indicator or something like that, and give you a different perspective on how you might be thinking about things. And today I want to talk, I'm not going to go a ton in depth here, but I want to bring up this idea of how do you figure out which online trading course is right for you. So if you're on Facebook, if you use social media at all, even if you watch business television, any one of those is going to expose you to a ton of different people hawking, pitching their course on how to make money. Sometimes they're advertised as, you know, how I turned $10,000 into $2.8 million in a year. And things like that, you know, the secrets of how to make money in the market. There are no secrets. There is no holy grail. And most of these people are terrific salespeople. I would say by and large, most of these people do not have anything that they're going to teach you that comes close to the value in dollar terms of what they're going to charge you to teach you these supposed secrets. In fact, I'd say that when you see an ad that says how to master the secrets, you know, of trading stocks or anything similar to that, I wouldn't even bother opening up that website or email or anything. And I say this in a good-natured way, but so many of the people who are out there trying to sell you the secret and how much money they made. I saw one recently of a guy sitting on a private airplane, and he was, the picture there is to try to make you think he's so wealthy that he has a private airplane taking him places because he's made so much money trading stocks. There's also targeted emails and advertisements to, let's say, older people, you know, how to make money in your retirement in the stock market. Sometimes there's targeted things like going after recent divorces, or going, you know, trying to target the female audience as if, you know, they've been undereducated. And there's somebody there trying to tell you, you know, as a woman, this is what you need to know how to become financially secure, etc. There's all different types of course advertisements out there of how to get ahead using this or using their particular, you know, secrets. And the reality is, and I can't say this 100%, and I'm not picking on any one course or company in particular here, but the reality is a couple things. One is, if their course or if their methodology was so good, I can promise you they wouldn't be selling it. There's no reason that they would sell it. They would have so much money that they wouldn't need to go marketing and dealing with all the things it takes to run a business. It's BS. And I'm not sure how to state it any clearer than the likelihood that you're going to get tremendous insights into something about how to trade the market in a course that costs several $1,000s is unlikely. And most of these people too, if you look at their backgrounds, they don't really have what we would call street credibility. They haven't worked at major Wall Street firms. If they have, check out what their role actually was. Many of these people were stockbrokers. Back in the day, you used to call them stockbrokers. Now we call them financial consultants. And it doesn't mean they don't pay attention to the market. They do. But that doesn't necessarily mean that they've come up with anything that is game-changing. And if they did, they certainly wouldn't be selling it. So just think about the difference between trying to educate yourself and understanding there's lots of different ways of approaching the market versus getting kind of suckered into some supposed secrets of the universe course that's going to make you a ton of money. Remember, there's a lot of snake oil salespeople out there who are so good at sales, they will hook you in and make you think that what they're giving you is magic, and it's only, $2,400, and or even if it's $1,000 and it could be $500. I'd be really careful about looking into who these people are, what's their background, and are they anything except really good marketers. So the ones that say, trade only 10 minutes a day, and you don't have to be glued to your screen. You'll trade between 9:30 and 9:40 in the morning, and your day is complete. And you know what? Same thing. It's bull. And it does mean sometimes the trades might not work, but I can say that the likelihood that it works with consistency, that you actually end up making money most days, or your net income from it is positive enough that it makes a difference, is low. So if you figure out, or when you try to figure out which online trading course is right for you, and it doesn't have to be online either. It could be somebody sending you discs. Doesn't matter what it is. I'd say really do your homework. Try to find out other people who have taken this. And the thing is, it's not going to be so easy to do that, because if you ask them, they're going to tell you, they'll have you talking to their brother and change their name so you don't know it's their brother, and they'll be touting and saying how wonderful it is. So be an educated consumer. Think back to the days of, what is the guy's name? Cy Sims, who used to have a discount like men's suit store. The educated consumer is our best customer. Know what you're buying before you spend a ton of money on something that promises you to find the secrets out there. There are no secrets. Okay. Let's take a look at some stocks now in the semiconductor space. So we will go here. We will switch to our first chart, which, here we go. So we're gonna default to weekly charts. Here's Nvidia. And you can see we are on all-time highs this week. And one of the things I want to show you, so look, I drew a channel line here. So the low in March dipped beneath it, we closed above it. So this is still a proper trend line. And instead of taking the channel, let's say, off of here, I actually just eyeballed this, and I could tell that there was a very strong trend line here. So I placed it on the trend line, and I'm looking at kind of where this measures to. And if we, for whatever reason, in the next month or so, get up towards this propulsion exhaustion level near 373, it lines up with where this orange line top of the channel is, up in this area here. And therefore, that would be a place I'd be very comfortable taking profits in Nvidia and looking for a pullback from there in order to get back in at some point. But to me, that's a very logical target. Look, it's the measured propulsion target anyway, off of the thrust from the lows. But the fact that it happens to coincide with this old trend line gives me even more reason to think that's probably a pretty good place. So you get north of 370, you want to take, or at least I would recommend taking money off the table. The other thing I want to show you here is, in a really strong bull market, if you look at how many times there were sequential 13s, either the standard or aggressive, you can see there are a ton of them. And so not even this model, which we often look like, which is an institutionally used model, is always going to get it right. And here you have such a strong bull market that you have 13 after 13, which means you had plenty of nines, because you can't even count to the 13 without the 9 counts. And it's just kind of showing you that even models that are used by the pros have their times that they're not going to work at all. More importantly, is that when you have a strong uptrend that gets a major pullback, notice where the 213s for buys came in. It came in 2019 on the low of the move, and well, actually the lowest low was here in December of 18, that Christmas bottom. But this actually got your 13s here twice in 2019. If you bought both of them, you basically bought the low of the move both times. And even if you did sell out on these 13s, you made a good amount of money. But this is a name, this is the star name in the semi space. It's up 38% this year, not including today. And this is the star of stars in the semiconductor space. Let's take kind of the second best, which is AMD. Here's a weekly of AMD. You can see it's not on all-time highs. It has stalled against sequential, aggressive, and standard 13s. You did get a pullback. And you can see here too, it had far less 13s on the way up. 9 counts weren't bad. Well, this one was good. This one was not. So none of these models, no matter how good they are always going to work. What generally, though, is that when you have good long-term bull markets, that when you get signals in the opposite direction, they tend to be the right timing of when to get in. So if I look at AMD, if this makes new highs, then it possibly gets, I'd say, 65, 66-ish becomes the next target, followed by 71-ish. On the downside, as long as it holds above 47.5 or so, it's okay. Get a few Friday closes beneath 47.5. It would say it opens the door to test this year's low. I don't think the broad market's going to test the low, but it is possible that something like a semi could, just because they're very high beta names. There's a name that a lot of people don't necessarily know. The ticker is ENTG. Oops, that's not correct. ENTG. There we go. This is up 14%. So this is kind of third best performing semi for the year. Again, you can see lots of 13s that didn't work. This one happened to call the all-time high when it was the all-time high, but so were these, and it didn't. But it does sell off into a 9 down, and that's often a place that we're going to look to counter, to have a counter move off of a 13, and it's gone. To the upside again, this is also beneath its all-time highs, but not by much. Upside targets are 63, and then on a really bullish move up to 74. As long as this stays above the low from about a month ago, I'd say 47-ish. It's okay. Under 47 becomes much more questionable. Let's look at Intel. Very different story. Notice 13 high into a 13 bottom, 9 high, test the same low. So there's clearly major support in the low 40s here. All-time highs are just off of a 9 count here. We're a little bit more than halfway up. Look for this to fill the gap. I can't really say right now that I have enough reason to think this is going up to 70. But more importantly, as long as it stays above 55.72, which you can see it tested, the propulsion downside level didn't get a proper signal beneath it. So as long as we're above 55.72, this is okay. If you break under 55.72, this becomes problematic. And we have time for one quick more. Let's do MRVL. And MRVL is near all-time highs too. Same thing, held where it needed to on the recent sell-off to 24.96. As long as we stay above that, give the bias to the upside. And targets here are about 29.75, something right shy of 30, has multiple targets there. So let's say 30-ish to 31 are the upside targets. That is it for this week. I hope you enjoyed the show. My name is Rick Bensignor, and this has been In the No Traitor.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.